Pzena, we follow a very rigorous investment process to identify the most compelling investment opportunities. Ultimately, we're looking to find good businesses trading at a substantial discount to what we think they're worth. The challenge is you don't find a good business trading at a substantial discount unless there's a problem. And so we take a very systematic approach to identifying, researching, and ultimately investing in these opportunities. We start our process with a screening tool called Stock Analyzer that we've developed internally. Stock Analyzer looks at 10 years of history for every company, and using that as a guide, projects it out to calculate our proprietary normal earnings estimate. Normal earnings you should think of as a year 5 mid-cycle cash EPS number. So Stock Analyzer takes that naive 10-year history, or takes the 10-year history to calculate the naive number, and ranks the stocks from cheapest to most expensive. We as a portfolio management team will screen through that cheapest 20% of the universe looking for interesting ideas. We come up with a list that then gets assigned to the analysts that are arranged by industry. Once the analyst gets the name to look at, they're tasked with answering 3 basic questions. First, what does this company do? How does it make money? Why does it exist? Second question is what happened? Why is the stock cheap? And why is there, what is the problem the company is facing? The third question is what do we have to believe in order to get comfortable with this investment? What are the 2 or 3 things that we really need to figure out, research, and get comfortable with that will make us say, yeah, this is a really compelling opportunity to invest. Once the analyst has answered these 3 questions, we then get together for our research review meetings. We have these meetings twice a week, and we have a discussion in this initial review around, okay, so what about this? What about that? Are these a couple issues that we want to focus on? Is there anything else we should think about? Have we seen this before? What other things can we do to figure out and how might we answer these questions? The goal of this meeting is not to resolve all the issues we've identified, but rather to figure out what the work plan is going forward and focus everybody on the 2 or 3 key issues. Once we leave that research review meeting, the analyst is then tasked with taking the lead on resolving the issues, whether it's through talking to experts in the industry, talking to the management team, talking to competition, tracking down data. Whatever it takes to resolve these issues, the analyst is going forward and kind of putting together a fully baked investment thesis. Once we have the fully baked thesis, we like to hop on a plane and go visit the company on site. We'll do these visits in pairs. A portfolio manager goes along with the analyst. And the goal of this meeting is really to be an audit of our work. We intentionally do this at the end of our process because we want to go there with our own views and engage management about their business. We're making sure that management, 1, acknowledges they have a problem, and 2, has a credible plan for resolving the issues. And these tend to be really robust and exciting conversations. We come back, we tie up any loose ends, and then we have another conversation in research review. The goal of this final research review is really to agree upon the normal earnings estimate and the normal earnings power of this company. So we start the process with a naive normal earnings estimate based on 10 years of history, and by the time we come out the other end, we've got a fully researched, fully investigated normal earnings estimate. If at that point the company is still in the cheapest 20% of the universe, it's a candidate to go into the portfolio.